I am Sarah Bradshaw, past president for NABIP Iowa chapter, and just want to thank everybody for being here, for all of the support that you give to NABIP throughout the year, and want to put a quick plug in for our golf outing that's coming up July 17th. So excited to see all of you there at Beaver Creek. We are going to go ahead and get started this morning with our first speaker. As a reminder, just want to ask everyone to please keep yourself muted with your video off during the presentation. And shortly, we are going to be posting a link in the chat that will allow you to fill out the continuing education form. This has been approved for 1 credit, and we will have a second session at 10 a.m. that will also be 1 credit. You will need to sign in separately for each session. So if you plan to attend the 10 o'clock, we will put the CE form in the link later on for that as well. We are going to be asking 2 polling questions throughout this session. So if you see that pop up, please go ahead and answer that question. If you have any firewalls restricting you from answering those questions or participating in the poll, you can chat to the NABIP Iowa chapter within this Zoom and give them your NPN number as well as your name, and we'll get you credit for answering that question. Want to give a shout out to Michelle Henneman with ClaimDoc. She is running our technology today. She's been a longtime member of NABIP and a good support for us. Okay, if you do have any questions throughout, please post them in the chat. We will address those at the end of the presentation, and then if there is time, we'll allow for live questions as well. With that, I am excited to introduce our first speaker of the morning. This is our Beyond Medicare Insurance Products for Older Americans with John Strawn. John is a sales account manager at Physicians Mutual Insurance Company. He has been with Physicians Mutual for almost 15 years. John routinely works with licensed agents throughout the country to better understand Medicare and senior-related insurance products. A graduate of Iowa State University, John began his career in the newspaper industry, serving as a writer, editor, and publisher for many years. In 2009, John earned his life insurance license along with his health and accident license. John and his wife Diane have been married nearly 40 years, congratulations, and raised 3 sons in the Des Moines area. John and Diane are also anxiously awaiting the arrival of their first grandchild this summer. Congratulations, John. I'll turn it over to you.
Oh, very good. I appreciate that, Sarah. And I thank everyone that's on the call today, and especially NABIP, for inviting me to present today. And I'm going to share my screen here and go through a few things, and hopefully I can do this correctly. So far, so good. I got to just make it bigger. There we go. How's that look, Sarah? Is it up?
That looks great.
Oh, okay, very good. Well, we'll get started. Um, you know, as I put together these slides, I was thinking of you folks that work in the health field. A lot of agents will focus just on selling that product. Either it's group insurance or ACA plans or even Medicare. And we have a tendency to get in the house, try to make the sale, get the heck out. I challenge you moving forward to be a little bit more holistic with your clients, especially that senior group. And the reason I say that is all those working years, they had an HR person they could rely on that told them every year, this is your new insurance, starts January 1st, and off they go with their new card. They took care of their life insurance, took care of their dental, their vision, all that other stuff through the HR department. Now they retire, they're given a gold watch, kicked out the door, and guess what? They don't have anybody to rely on anymore. You become their HR person in retirement. And being that HR person, you should be much more holistic than just selling Medicare products. Um, and my challenge to you today is to think about how you can incorporate these things into your presentation, how you can help folks bridge into retirement and have some peace of mind going through those phases. It's interesting that during when NABIP had the conference over in Altoona a couple weeks ago, there was also a large gathering in Las Vegas. It was called Medicarians. Medicarians draw, health agents like us to that event. And I talked to a lot of my colleagues that did attend that because I was at your conference in Altoona, but they were telling me that the number one theme during Medicarians was cross-selling, adding products, helping folks fill those gaps because, as many of you are well aware, you get to AEP and you're not getting paid on your PDB plans. A lot of times you're not getting paid on your MAPPOs and you're getting boxed in financially yourself. You better find another way or a replacement income stream to help people. You're helping them and you're also helping yourself. Uh, last I looked, now don't be offended by this, but if you are a ship advisor, that's great. But as a licensed professional, we're not volunteers. We're not ship representatives. So we have an obligation to feed our families. But kind of keep that in mind as I go through here. As Sarah mentioned, throw things in the chat. I might not see it right away, but we will go over any of your questions. My contact information is listed on this slide, so always feel free if you need something, uh, shoot me an email or give me a call. I'd be happy to work through it with you. So, taking a more holistic approach. As an industry, are we helping people protect against the unexpected expenses related to critical medical events and end-of-life needs? Kind of think through that. Are you doing that? Do we take the time to ask those critical questions to reveal the needs? Are we professionally able to meet those needs with specific insurance products designed to meet their needs? And do we have the facts to support a recommendation? And it all boils down to what's in the best interest of the client. We don't want to sell product just to sell product. We want to try to help them and give them that peace of mind when they're in retirement. Now, one of the tools we use, and you guys can develop your own, or I can shoot you a copy of this, it's not proprietary, but we use a assessment tool that what we call our fact finder when we're in the home because we want to know what's most important to the client. Yeah, I'm here to talk to you, Joe, today about Medicare. But I would like to ask you a few questions because I don't want us to miss anything. Because you can put a side-by-side comparison. It doesn't have to be a med sub, doesn't have to be an MA. Everybody has different needs. We fulfill that need first, and then we start looking for other areas because they're going into retirement. Did you have dental insurance when you were working? That's yes or no. Okay, if it's yes, is that still important to you in retirement? Because, and I'm not going to drill down on dental protection, but they tell us the first three things to go is your eyes, your teeth, and your hearing, and in my case, my hair. But dental insurance is super important, especially to seniors, because most of the time that's going to be a major expense because they're getting older. Teeth need some attention, and it can be very expensive. Extended cancer protection, which I'm going to get to here in a second. Have you ever known anybody in your family or one of your friends to ever have a cancer diagnosis? 9 times out of 10, they're going to tell you, yeah, I know somebody. Well, how'd they pay for that? Because that's super expensive if you have uh, cancer diagnosis. So you got to drill down a little further. Life insurance. We're going to go over that a little bit more here this morning, but do you currently have life insurance? Also a yes or no question. Oh, you have life insurance. When's the last time you had that professionally assessed? They may say never. I bought it, I put it in the safe, never thought about it again. Because if they have term insurance and it's going to come due soon, they might want to know about that. Maybe they got a boatload of whole life. I don't know, but we have an obligation to ask those other questions, other health benefits, vision, hearing, prescription drugs. It all comes into play. And then even income. As I'll mention in the life part of this presentation, we should be selling Social Security insurance. You're thinking, what the heck's that? Well, when you have a married couple and they're each getting their Social Security check and Joe dies, Sally's left behind, but she's not going to get two checks anymore. We have to find a way to replace that income if that's important to them. Kind of like a pension. That one dies, the other one might get something, they might not. But what is Social Security? It's a pension program designed by the federal government back in 1932. So things have evolved over time and people have specific needs in retirement. So using a tool like this will be very helpful. And it also protects you a little bit more because you have everything documented. We even use just a one-page sheet. We write out, okay, this is how much your med sup will cost, this is how much your dental, your cancer, your life, and we put it on a single piece of paper. And I'll ask the client, which one of those do you not want to be protected for? And they might say, I don't need dental, I have dentures. Okay, cross that out and initial next to it. That I want to put that in their file. Same way with cancer protection. I don't think I need that. Because sure enough, as soon as that person has a cancer diagnosis, you're going to get a phone call. And they're going to ask you, do we have some protection on cancer? No, he signed off on that when we met 3 years ago. He didn't want it. So you protect yourself a little bit more as an agent. Okay, so extended cancer protection. And this comes from the government, the Cancer Action Network, American Cancer Society. You should be thinking when we talk about cancer protection, that's something we sell. I'm not saying you need our product, but there's other carriers that offer this type of coverage. But a couple of questions. Do you know anyone who's battled cancer? And the other question is how did they pay for that? Because statistically, this is just a map of the United States on their 2026 figures. These are estimates on how many people will be diagnosed with cancer in 2026. Statistically, 1 in 2 men, 1 in 3 women will have some type of cancer diagnosis in their lifetime. Iowa is the first or second, I think it's the second highest state in the union for cancer diagnosis. Why that is, I think they're trying to get down to the nuts and bolts of what's causing that in our population, but it could be the air we breathe, the water we drink, the food we eat, just environmental causes, could be hereditary, could be all kinds of things. But that's a startling statistic. We have to be preparing seniors that this could happen because we don't know really the day we're going to get sick or the day we're going to die. And the day we're going to die is 100% certainty. I will guarantee you that. But a cancer diagnosis, it's a pretty high percentage for that. 50% of men, 33.5% of women. That's that's a huge number. 22,710 cases expected in Iowa this calendar year. That's a lot of people out of what we got, 3.5 million people in the state. That's a good portion. Yeah, other states are much larger population. They're going to have higher counts on that, but nevertheless. Okay, this is also from that same website, the American Cancer Society, just shows us the types of cancer that people are, depending on gender, what is the highest on the list. Prostate cancer in men, breast cancer in women, and then lung and bronchitis for both. It's it's important to be uh, telling your clients you need to get your screenings. You need to be on top of this because if you can catch cancer earlier, you have a much better chance of survival than if you put that appointment off, you don't do it, and it's stage 4, nobody's going to can do a whole lot for you. So if they are equipped with the financial resources to be able to do that, they're more likely to have their screenings done. Here's some interesting statistics, and you may be surprised to know some of these things. So, breast cancer is the most frequent diagnosed cancer for women. And as I noted, prostate cancer, most commonly diagnosed cancer in men, aside from skin cancer. An estimated 88% of all cancers are diagnosed in people 50 and older. In 2026, a little over 2.1 million new cases of cancer are expected to be diagnosed in the United States of America. That's a huge number. In 2026, over 1,700 people each and every day are expected to die from cancer. That's 626,000 for the year. That's a lot of people. And uninsured patients may be more likely to get their diagnosis at a later stage when treatment can be more expensive and invasive. So we need to be ahead of this curve. But there is some good news. The 5-year survival rate, hold on, the 5-year survival rate for cancers diagnosed from 2015 through 2021 was 70%, and that's up from 49% in the mid 70s. So technology is keeping pace with that. Oh, there we go. For breast cancer, the 5-year survival rate is 92%. And for prostate cancer, it's 98% for all stages combined. So that's good news. And supplemental insurance policies, like this cancer insurance that we're talking about, or extended cancer protection, those are types of products that are available to help cover what original Medicare, Medicare Advantage, and major medical insurance doesn't cover. I think the key critical thing I know with our underwriting, if you ever had an internal cancer diagnosis, we will not issue that policy. So you got to catch people when they're younger and healthier in order to buy that. It's just something that you got to think of as you're talking to your clients. And these cancer costs are rising all the time. It keeps going up. Patient out-of-pocket costs, $5.6 billion. That's a lot out of pocket costs, 5.6 billion. And if you read through here, approximate cancer also represents a significant portion of total U.S. healthcare spending. Approximately 183 billion was spent in the U.S. on cancer-related care in 2015. This amount is projected to grow to 246 billion by the year 2030, an increase of 34%. That's not sustainable, folks. We can't expect seniors on a relatively fixed income to keep hammering away at all these extra costs. And these things are rising. Cancer always comes with a cost. By 2030, you're up to $245 billion in cost, 34% increase over 2015. And even with the cancer, that's just the medical side of it. You have to also consider there's other expenses involved with a cancer diagnosis. A lot of people in Iowa, they live out in the rural areas. They have to have the transportation to get to Des Moines, get Cedar Rapids, Iowa City, Cedar Falls, Waterloo, Sioux City, the major metro areas to receive care, or even Mayo Clinic up in Minnesota. So you got transportation, you got lodging. When you go, most likely you're not going to be hospitalized. You're just going for your treatments. Sometimes you got to be there, 7 in the morning. People can't drive 3 hours and be there at 7 in the morning. They might have some lodging, lost wages or income. Because when you go, you're probably not going to go by yourself. You're bringing your spouse or significant other with you. They have to miss work. Those are lost wages. Secondary effects. Some patients must treat or deal with secondary effects of cancer treatment, like fertility treatments, wigs, cosmetic items, or the cost of special food. These things add up, and caregiver costs. Not only for a senior, because most likely, you hope, the kids are out of the nest. You don't have to worry about daycare for those, but they probably have pets. Somebody has to walk the dog. Somebody has to check on the cats. All those have inherent costs that a cancer plan can help contain, or at least help financially with. So there's all kinds of things that people are worried about. And if you talk to them, they will agree with you that, yeah, maybe I should have some protection in case that happens. I'd rather have them make a $50 a month mistake than a $50,000 or better medical bill down the road. Now, this is how our plan is designed. Every carrier is going to be a little different, but since I had access to ours, I made a copy or put this up on this slide. Most of these cancer plans are going to cover a certain dollar amount, or they're going to pay out a certain dollar amount for things people have done. And with ours, people can either buy 1 unit of protection or 2 units of protection. The 2 units just double the amount of benefit they receive if they come across these things. But if somebody has 2 units of protection, they went and did their annual screening, they get $100 because they went and did their annual screening. Now, let's say they're hospitalized because of a cancer diagnosis. They can get up to $300 per day with this. So think of the MA plan. If you're hospitalized, well, you're paying $300, $500, $600 a day to be in the hospital. This, along with an MA plan, might be a good fit because at least here they could get $300 a day because they were in the hospital and help pay those copays with their current plan. And then treatments, cancer treatments, you got things like chemotherapy, radiation, hormone replacement, and things like that. Up to, with our 2 unit plan, $16,000 worth of benefits. I'm going to move this out of the way. $16,000 per calendar year in benefits for those cancer treatments. And there's benefits also for like surgeries, anesthesia, blood and plasma, hospice care. Yeah, we know Medicare and the MA plans pay virtually everything for hospice care. But if this paid $60 a day for up to 180 days, I think the beneficiary would appreciate that check. Ambulance rides, home health care benefits, inpatient private duty nursing care, inpatient drugs and medicine benefits. The cancer drugs are very, very, very expensive. Yeah, does this pay everything? No, but it sure takes the bite out of those things. And miscellaneous treatments for reconstructive surgery, artificial limbs, hair pieces, those type of things are built into plans like this, along with transportation lodging benefit. They can get up to $2,000 lifetime maximum on the 2-unit plan for transportation and lodging. That would probably come in handy. So most carriers are going to have you create a base policy first, so 1 unit or 2 units of protection, and then you move on and ask about adding a rider. Okay. We offer 2 different types of riders with ours, but focus on that internal cancer benefit rider. So people will opt for a $10,000 lump sum in the event that they're diagnosed with cancer. You have an internal cancer diagnosis, we send you a check for $10,000, no questions asked. Spend the money however you want to. This is an indemnity product. It pays those certain dollar amounts and it just keeps coming to them because do you want to fight cancer with or without money? $10,000 won't go too terribly far in a cancer diagnosis situation and treatment, but it's better than zero. So in ours, we do offer different lump sum limits, 5,000, 2,500, if that better fits their needs. And then the first diagnosis for critical illness benefit rider for heart attack, stroke, or heart bypass surgery. Depending on their age, they could add that rider with a benefit of up to $20,000. Um, Most of the clients I talk to qualify for only the 10,000 because our underwriting wouldn't allow 20,000 over the age of 60. So there's, depends on the situation you're working with. Typical underwriting questions. Um, and most carriers are going to be along the same lines on this. Some might say, have you had internal cancer in the last 10 years? So if they had something more than 10 years ago and they're not being, it's all in the past and not receiving treatment for it, they may gain coverage. Ours says ever. So it depends on the carrier you're working with on that. Or if they have outstanding screenings and test results that have not come back yet, we just have to wait that out till they get those results before moving forward. Or no indication of skin cancer in the last 3 years. And then there's different things that go along with that first diagnosis critical illness rider. I'm not going to go through all that, but you'll have to understand the product really well before you present it to your clients as a solution to their needs. So I'll pause here for a second. Any questions related to extended cancer protection?
John, I have a question. So you may have touched on this a little bit, but are there certain policy language that we should be looking out for when it comes to reoccurrence benefits?
For reoccurrence? Oh,
So a reoccurring cancer or um, because some might be less restrictive in
hmm
that area.
hmm yeah. So with that, okay, so for ours, you have that first diagnosis, we send you the $10,000 lump sum, and then that rider drops off. So it's only one time, but they maintain that schedule, those units, because yeah, we know maybe 2 years from now they have a reoccurrence and they end up back in the hospital again. So those things kick back in again,
Great,
according to
thank
the
you.
limitations of it. Yep. Yeah, they don't want to drop it once they have it. It's pretty important.
Right.
John, this is Marcy. I love this. This is such good timely information, especially what's going on in the Medicare space. But not only that, I feel too that, out-of-pocket costs have gone up and there's a lot more exposure on people especially in this space. So, cross-selling is one thing, but actually providing benefits that are really going to help these people.
Mhm.
So what happens if you are somebody who maybe had, like, I'm just going to give you an example. My mom had thyroid cancer many, many years ago. I mean, I'm 50. I was in high school still when she had her
Mhm.
surgery. Of course, taking the levothyroxine, but has had no complications or no other signs of cancer. Is this something that you think would be, she'd be able to get through underwriting, to be able to get the cancer policy? Or since she's got some sort of a history of it, is it going to be a little bit harder to get through underwriting?
Right. So with us, I know from firsthand experience, she would not qualify for us because the question says ever. Have you ever had? So that could be, your entire life. Some carriers will only go back so many years, 10 years, 15 years, or whatever. And then those type of plans which would be very similar to how I outlined it, would be available to your mom.
Okay, that sounds good. I have one parent that's never been diagnosed, so it's still great, product for him
Yep,
as he gets
absolutely.
up there in years. But
Yep,
yeah, thank you.
you're welcome. And premium prices on these things are going to vary according to the age of the applicant. So obviously, older people might cost a little bit more per month than somebody that's in their 30s. Just kind of keep that in mind. You can with us, you can sell this to anybody 18 years or older, and they can even add if they have children. So they're in their mid 30s, they got a couple kids. You can add the kids to that policy. So, God forbid that a child gets cancer, but it happens. I mean, there's a huge hospital in Iowa City full of sick kids. So you just never know. And that can be very devastating. Okay, let's move on a little bit to life insurance. I have found over the course of my career that most health agents have a life license, but they've been so far into helping people with their health insurance, they totally forgot all the rules when it comes to life insurance. So I want to go through that a little bit with you here today. Why consider life insurance? What is whole life? What is term insurance? And understanding that life insurance features can vary along the way. So, because we want to close that knowledge gap for health producers when it comes to these life products. So, why consider life insurance in the first place? So life insurance is a financial tool that is an important part of complete financial plan. You pay your premiums to the insurance company, and in exchange for that, the company will pay a lump sum death benefit to your beneficiaries when you die. I should take that if out of there because we know that's going to happen. The cost of the premiums are going to depend on the type of life insurance, your age, and other health factors. Because sometimes you pay a little bit more because you're a little bit more medically um, deemed to not have a huge life expectancy. You might have to pay a little bit more in your premiums for that. But it comes down to their budget. We have to be budget friendly on these type of things because whole life is going to require a larger financial commitment. It's always a little more expensive than term. It has to fit their financial goals. Term for temporary needs, but whole life for permanent needs and maybe to leave a legacy. And term is fairly simple to understand. Whole life, on the other hand, can add some complexity with cash values, loans, depending on if it's a universal life, what it is. But we'll go through some of those here this morning. Why do people need life insurance in the first place? Income replacement. When families that rely on your income, that death benefit can replace lost wages to cover ongoing living expenses like groceries, utilities, daily needs, helping your family members maintain their standard of living. It may be used to cover debts and mortgages. You'd be surprised, statistically, how many more seniors nowadays carry a mortgage into retirement. Used to be you paid off your mortgage in 30 years, you retired, and that house is yours. Not anymore. People have these mortgages they have to worry about. And if you die, how's your spouse going to pay off those loans or other outstanding debt, credit card bills, car loans, private student loans? It's something that's become more common in our society today. Paying final expense. A funeral costs money. Trust me, when my mother passed away, and I knew this was coming, first thing I arrive at the funeral home and the guy says, "Come here, you gotta come in my office, we gotta talk a bit." Fortunately, mom had already set up that this was all prepaid, but his question was, who's paying for this? And an average cost of a funeral is going to run in Iowa. It depends if you're going out in a box or an urn. Sorry for being crass on that, but that you're going out one way or another. It's going to cost money anywhere from 10,000 to 20,000, unless you get a, you know, um, a really, really big funeral going. But keep that in mind. Estate planning and taxes, leaving a legacy. Some people want to leave some money to their family. They want to leave money to their church. They want to leave money to the Humane Society. Where does that money going to come from? If it comes from life insurance, it makes things a lot more simple. Business protection. If you're in business with another person, the LLC or a S corp or just a hey, I'm getting in business with Johnny thing. If one dies, the other one's left holding the bag with only 50% or less equity in there. How are they going to buy out the other person? So that gets a little more complicated, but there are plans that can help that. And peace of mind uh, for families. I tell people when I talk about life insurance, when you pass away, Joe, you're going to become a emotional burden and a financial burden on your family. I can only help you with the financial end of it. So we need to make sure something is in place. So what's whole life insurance? Whole life insurance is for your whole life, the entirety of your life. So think of it that way. You buy this product, you're going to pay premiums on it until you die. Okay, but it's there. It's set. The premiums won't increase. Depends on when you buy it at your age, but it won't increase over time on the premiums. And this is good for estate planning, leaving a guaranteed inheritance, long-term wealth building, as it combines insurance with savings because the coverage is permanent, whole life is permanent, as long as the premiums are being paid. And the cost is fixed month to month. They know how much they're going to have to budget for that life insurance. And it builds tax deferred cash value that grows over time, which you can borrow against it. I don't highly advise people borrowing against their life insurance. Now, I'm not a financial planner, but usually those interest rates are 7.5 to 10% to borrow your own money. You might be better off borrowing money from the bank, but there is a provision in there that you can borrow against your cash value. And at the end, if you had 50,000 in whole life insurance and you borrowed 20,000 and you never paid back the 20,000, you just kept it and it was incurring interest. And then you die, then the insurance company's going to take the difference, the 50 minus the loan, 20, and any interest that built up. So the most you'd get would be the beneficiary would get would be 30,000 because you borrowed that money out of it before you passed away. Industry standard is you get to 121 years old, which I don't know anybody on the planet at 121, but technology, if we get to 121, they're going to send you the entire death benefit before you die. So go on a cruise, do what you want. Um, that's how that works. So what's term insurance? Term insurance is shorter in length. It's not for your whole life, it's just for a short duration of time. And that can be 5 years, 10 years, 20 years, maybe 30 years is your term. Okay, so it'll depend on your age when you buy it, how long you can get a term to go. But term is a lot cheaper premium wise than whole life because it's for a set time frame. But people will get that to cover their mortgages, raising kids, income replacement if you die too soon, um, those type of things, and it's more affordable for a lot of families, but it does expire at a certain time. There's no cash value, no investment component to term insurance. So you got to keep that in mind when you're trying to come up with a solution for your client and if they can qualify for that. So this little chart kind of shows you um, what term is for and what whole life is for. Term is for specific term of years. Its cost is lower, no cash value, level term, and then it will increase. So if you have a 10-year term, and some will give you automatic renewable term that you could do, but I will tell you that that premium is going to go about 5 times more. So if you're paying $100 a month and the term expires, you might have to pay $500 a month to keep it in force. And you're thinking, why would you do that? Well, if you're given a medical diagnosis that you only have 6 months to live and your term is just about ready to expire, if it's me, I'm paying $500, $1,000 a month to get the 100,000 in face value because I know I can't get it. I can't get other insurance, life insurance now because I'm about ready to die. Nobody's going to insure that. So it depends on the situation at the time. But whole life insurance is significantly higher in cost, but it's level for their life, and you know how much the beneficiary is going to receive when they pass away. So let's understand some of the life features. So you have to name a beneficiary. You got first in line. Normally that's going to be a spouse, or it doesn't have to be a spouse. It can be whoever you name as the primary beneficiary has the first legal claim to those assets upon your death. And they are the ones that are going to receive the face amount when you pass away. And it can be more than one primary beneficiary. Let's say you want to name your wife at 50% and your son at 50%. They'd each be primary beneficiaries and they're both first in line. And then you have contingent beneficiaries. Let's say you only have your spouse on there as the primary beneficiary, but you're in a car accident and you both die on the same day or right about the same time. Then it goes to your contingent beneficiaries. Another example would be you have a life insurance policy, your spouse is on there, and she dies first, and you forgot to update your beneficiary form. Well, that's okay because she's no longer with us. It would go to your contingents upon your death. So it will work out, but they should always have at least one contingent beneficiary. Otherwise, it goes to the state, and then the state has to figure out who the heck is supposed to get these funds. You avoid probate with this because it goes to who you wanted it to go to, and it prevents delays. So somebody's going to notify the insurance company. You send them a death certificate, claim form. They in return will send that check either to the agent to hand deliver or to the beneficiary, however it's set up, and it gets taken care of. Comprehensive planning, it covers scenarios like your private beneficiary dying before you or at the same time as you, as I just discussed. So things to keep in mind. There's in whole life, there's things called non-forfeiture options. These options ensure that the policy owner does not lose all value if they stop paying premiums after a certain period of time. Because there's a cash surrender value. The policy owner receives the accumulated cash value of the policy as a lump sum payment, minus any outstanding loans or surrender charges, and the policy then terminates. So if somebody has a huge amount of cash value in their policy and they're like, I'd rather have that. I'm not too worried about final expenses. So we got plenty of money. I'll just take the money out, invest it differently. That's fine. That's an option. There are reduced paid up insurance policies, meaning that the cash value is accumulated to a point that they can swap it. I'll use that cash value to lock in maybe just a final expense. I'm okay giving up the $50,000 face value to get 25,000 guaranteed. I don't have to pay for it anymore. So that takes one less thing out of my budget, but I know when I die, my beneficiary will receive $25,000. That's an option. Extended term insurance. The policy's cash value is used to purchase a temporary term life policy with the same type of death benefit as the original policy. No further premiums are owed, but the coverage only lasts for a specific amount of time because it's term now. And that's determined by the amount of cash value that's available in that whole life policy at the time they make that decision. And if the insured outlives the term, well, the coverage will end because the term expired. And this option generally provides the highest death benefit among the non-forfeiture options that we've just discussed while the coverage is in force. And there's an automatic premium loan provision in those as well. The insurer automatically uses the available cash value to pay for any overdue premiums, things to keep that policy in force. So there's all kinds of mechanisms that are within a whole life plan. Now, term, this is different because it can renew as annual renewable term. How that works is you keep your policy, but you're going to pay a higher premium each year as you get older. The good thing is you don't have to go through any new medical exam and you keep the coverage you have. But the downside is the cost will increase exponentially over time. So some people might just replace a term for a new term. They'll pay a higher premium because they're 15, 20 years older than when they originally bought it. But it can, if they can't qualify for it through medical underwriting because something's come up along the way, i.e. a cancer diagnosis, at least they have some options here in most cases. And like I said, you can buy a new policy or you just let it lapse because people's needs change. You might let it lapse because now my mortgage is all paid off. I don't have to worry about that any longer. And Susie Q can get along just fine without my income. Okay. Typical riders that will come with these type of life insurance products, especially if it's a whole life one, you can get accelerated death benefits. It will pay a portion of the death benefit early if you're diagnosed with a terminal illness. Many cases, about 50% of the death benefit. So if you're going through extensive cancer treatments and expenses are adding up, you can tap into it. Say it's a $50,000 policy, you could get 25,000 out. But keep in mind, your beneficiaries only receive the balance when you pass. There's a critical chronic illness rider in there too. It helps pay for different conditions and stuff. And there's long-term care provisions in many of them. It's a hybrid thing. Now, those are a little harder to find out there in the market, but if you get good at life insurance, people need long-term care. More and more people end up in a nursing home these days. So, um, excuse me. Um, and there's disability premium protection riders, waiver of premiums, and that waives the future premiums if you become totally disabled. That can be part of there. accidental death and dismemberment benefit. If you die by an accident and you have that little rider on there, you're probably paying $3 a month for it. But sometimes you can get the face value to double by paying because it's rare that people die from accidents. But I see the road sign. I think it was up to 80 um, deaths so far in Iowa this year on the roadways. So those things do happen. I'll wrap up here real quick because my time's about ready to expire. I'm about ready to expire. But typical life insurance riders continued here is guaranteed insurability. In some cases, you can just add to your current policy. If you so wish, you'll get maybe an offer in the mail or something. Hey, Joe, add $10,000 in coverage for another $20 a month. It's guaranteed insurable, meaning company's good with offering that to you, and you can take advantage of it, yes or no on that. Term riders, add some temporary protection to a permanent one. I know there's new products coming out these days. You got whole life base, and you can add some term riders to bridge some gaps. Those are good too. Return a premium, refunds the premiums paid in if the policy ends without a claim. Often those are on term policies. Travel and accident rider, they're going to go to Europe and they get in a bad accident over there or something like that and end up dying. It'll help pay a lump sum for the accidental loss of life during travel, excluding illness, suicide, or high risk activity. So don't go off-roading when you're in Zimbabwe. Typical life insurance riders continued here too. There's child riders. You can add your children in there. And just in case something, God forbid, happens to a child, usually that's going to be limited to maybe $10,000, $12,000 face on those because children normally don't have a need for income replacement. But the family income benefit would provide a monthly income to the beneficiaries for a set period of years. So depends on what you're looking for. Questions?
Thanks, John. Appreciate all those great insights today. It's definitely something that's not easy to talk about, but definitely important to plan for. Many of us have experienced this with loved ones. We did have some helpful hints in the chat that I'll share.
Mhm.
Just for some, depending on your situation, it may make sense to purchase the burial items outside of the funeral home. And or go directly to those vendors. So whatever works best for you and your family, but there's certainly ways where you can save some money along the way for those burial expenses.
Absolutely.
Anybody else have any questions or comments for John? We're getting some thank yous.
Some thumbs down too. No.
No, very helpful information,
Oh, good. Good.
right? Great class. Yeah, a lot of great feedback for you, John. So
Good.
really do appreciate you sharing all of this information. Who knew that life insurance could be so complicated and
Yeah.
with so many options? But really important as we are out there advising our clients, even our friends and neighbors and family, to just understand what all is involved. Well, welcome everyone for the second session this morning. For those of you that are just joining for this second session, I am Sarah Bradshaw, past president of the NABIP Iowa chapter, joined today by a lot of other NABIP members. So happy to have so many of you on the call. And then Michelle Henneman with ClaimDoc, she is running our technology and she has been a long time member of NABIP as well. So thank you, Michelle, for all your support there. Just a few housekeeping items. Please remember to keep your phone on mute as well as your video turned off. And if you do have any questions throughout the presentation, I ask that you please drop those in the chat. We will be posting a CE link that you will need to fill out for this session. So make sure you take care of that, and that will be posted in the chat as well. And the polling questions will pop up randomly. There will be 2 of them throughout this presentation, so please make sure that you do respond to those. If you have any issues with responding to the firewall or due to firewalls or filling out the CE forms, please message the NABIP Iowa chapter in the chat and send them your NPN number as well as your name, and we'll make sure to get you recorded for those questions and for your attendance. We will be taking questions, like I mentioned in the chat. Please feel free to drop those in, and then at the end, we'll make time to ask all of those questions. All right, so with that, I have the honor of introducing our next speaker, and the topic today will be understanding long-term care hybrid solutions. A very nice lead-in from our prior session for those of you that joined earlier. We do have today presenting Justin Wagner, and Justin is PIPAC's Life and Annuity Department Manager and a CLU designated professional with 11 years of industry experience. Justin supports agents across the brokerage with clear, actionable guidance on life, annuity, and long-term care solutions. Today, Justin is here to break down long-term care planning and highlight what advisors can put into practice right away. With that, thank you, Justin, for joining us, and take it away.
Yes, thank you very much, Sarah. Thanks to all of you for taking some time out of your morning to learn a little bit more about life insurance and long-term care. I know that you guys have a lot to do, so we really appreciate when you take some time out of your day to spend it with us and learn a little bit more about the industry. Sarah already kind of introduced me, so I'll skip that slide. And we'll just kind of get right into it. I know I'm sure that all of you are hearing about long-term care pretty regularly, even if you're not really working in that space or you're not selling a lot of it. I'm sure you're hearing about it a lot. We certainly are as well. Here at PIPAC, we quote a lot of long-term care. But on the flip side, percentage-wise is one of the things compared to how many quotes to how many sales, there's a lower close ratio. And why would that be? So that's one of the things we're going to talk about. People who are looking for it, where they fit, and what kind of products fit those people and what's best, and kind of bucking the trend of what we tend to have done in the past when we're running long-term care. So number one, why does long-term care matter? We know that people are living longer, which of course is great, but with longevity brings, of course, new challenges. Most Americans are going to need some kind of long-term care. That's just a fact. People can try to explain away the fact that, oh no, maybe you hear that especially from men. My wife will take care of me. Who's going to take care of her? Maybe that's true. But right now, you have to assume, based on the numbers, that you're going to experience a long-term care event because most people do. We see the stats there. It's around 70%. Most people are going to experience a long-term care event. So planning for a long-term care event is just smart. There's really not a reason to do it. So a lot of people wonder, what can long-term care pay for? We typically think of long-term care as the facility, right? The place where you're there, maybe the last couple of years of your life. That's what most people think of when they think of long-term care. And really, long-term care products can pay for so much more than that. We actually like to present long-term care as a stay-at-home longer solution, which people really respond to, because at the end of the day, that's what people are really wanting to do, right? Stay at home as long as possible, delay that need to go into a long-term care facility. How can I do that? Well, you can use your long-term care policy to do that. People can come in and help you. We need those acts of daily living that you hear about all the time, bathing, toileting, dressing, eating, things like that. People can come in and help you with that, and you can use your policy to do that. So again, kind of change that mindset. Think of long-term care policies as also a stay-at-home longer policy. Use it for home health care. Now, this is a big one, of course. We know, especially if you have had somebody, a loved one in that long-term care facility or somebody who has experienced this. And that, of course, is usually when you have clients coming to you, is when mom or dad go into the long-term care facility or another loved one. Something has happened in their lives and they've finally really understood the cost of care today. And there's a lot of really great websites where you can go and look up what the cost is in your area. We can provide those to you if you need that. I know Genworth has one, but around here in Iowa, we're talking, 10,000 plus a month for a really nice, a relatively nice long-term care facility. I mean, otherwise you're talking about $60,000 a year. If you want your own room in a nice nursing home, over $100,000 is not abnormal. And most of these numbers are pulled just using Iowa and the Midwest. And those costs are increasing. So it isn't getting any better than it is today. So we need to make sure that we're planning, because if you don't, these kind of numbers, of course, are going to wipe out everything that you've built really, really quickly. When it comes to long-term care, this is a really, really big thing that we have made a point to have that emotional connection with the clients. That's really, really important. If you're not used to selling long-term care, taking time to really dig into their unique experience, why they want it, what they can afford, things like that will really go a long way, because this is a big expense, likely to be a very big expense. And it becomes a tough choice to make when they're deciding between purchasing long-term care or hoping they don't end up having a long-term care event. So you see, especially, that first section there, families often become default caregivers, and that's true. And again, some people, that's their plan. That's what they're thinking about. It isn't just about money. Long-term care isn't just about money. It's also about dignity. Like, you don't want to be in the gross nursing home. Everybody knows of the gross local nursing home that you don't want to be in. How do we avoid that? The caregivers who take care of the people who maybe should be in a long-term care facility. I'm sure you've all heard story after story of the spouse that took care of their husband, and by the time he passed, they had been taking care of him basically 24/7 for a few years probably. And the toll it takes on them is also extreme. And then their health starts to fail. And hopefully there's something in plan for them. But if there wasn't, they spend those years taking care of a loved one, and all of a sudden they're in, a nursing home that they would rather not be in. So there's so much more to it than just, end of life care. Uh, the ability to have the choice to go where you want. That's really powerful. And we all know that. If you really think about your own life, your own experience, you're hoping to be in that nicer place. You're going to have that choice. You're going to have this planned out. And that is a burden that comes off of your loved ones. Absolutely. It's awesome to hear if any of you have had parents come up to you and say, "Hey, this is our plan. This is how we're paying for it. This is where we're going. You won't need to worry about it." That's powerful. And you're just very thankful for those people who have made that choice. So that's another thing you kind of want to have that conversation with those clients, make sure they really understand not only the likelihood, but the emotional part of it as well, because that connection obviously leads to sales, and that's an important part of them understanding what they're purchasing. So with all that being said, really, we focus on two different types of long-term care insurance, and I kind of liken it to the Medicare space, right? Like, it seems like there's a lot out there. And for me, who doesn't work in that side, it seems confusing, and it's always changing, and staying on top of that. And do I even know what I'm talking about? Long-term care can feel the same way. So how do you keep it simple? How do you make sure that the clients really understand what they're buying? What are the pros and cons of both types of long-term care insurance? So the pros to right now, we're going to talk about traditional long-term care insurance. Sure, a lot of you are very, very familiar with it. Big companies like Genworth, John Hancock, Transamerica, Mutual Omaha, these massive carriers who have done long-term care for a long, long time. Out of all those ones that I just named, only one of them still does it, and that's Mutual Omaha. All of those carriers have gotten out of that market because they priced their products inappropriately or did not plan for the type of claims they were going to have. And as a result, they have had to step back out of that market just to make sure they can pay for the people who still have policies in force. So traditional long-term care, talking about those clients again, I mean, those carriers, Mutual Omaha is our main one. Those are the traditional, most people call and they ask for, we want $100 a day, 3-year benefit, inflation, 90-day elimination. Those traditional ones, this is what we're talking about. What's the pros and cons to that traditional long-term care insurance? Well, the biggest pro, of course, is it's typically the most cost-effective way to get into long-term care, to get coverage, is to buy a traditional long-term care policy. Their premiums are going to be lower at first. The ability to dial in, really specifically dial in what you're looking for your care, for your benefits, is very helpful as well. A lot of carriers won't do that to anywhere near the kind of degree that you can with traditional long-term care insurance. The big giant cons for traditional long-term care, which we hear all the time, number one is the premium could increase, and it will. I wouldn't say it may. It certainly will. Just like any other kind of insurance, they'll monitor if this block of policies that your policy is in has more claims than it has premium coming in, they're going to increase your premium, and they'll request that to the state, and they'll get a letter saying, this is going up X amount. Sometimes they'll even say, we at Mutual Omaha requested $1,000. The state said 500. So then your client knows they're probably going to get another increase coming up. And that scares a lot of people away. And primarily because, of course, they're putting this in their budget. They're buying, as much as they can afford typically. Maybe they're not putting it to the end of their budget, but they're buying quite a bit. And the knowledge that it might increase and change their budget is scary to a lot of people. Now, the flip side of that is that even with some price increases, it's still not going to be as expensive as your hybrid products or your life with long-term care rider products. Mutual Omaha is going to almost always come in, for apples to apples comparisons, more affordable than that type of solution. So while it may seem scary at first, and we'll talk about a couple of those other objections here later, but while it may seem scary at first, it's really not as bad as it sounds. But that unknown is unsettling some people, and I understand that. The other big one, of course, is the use it or lose it. What happens if we don't use it? Well, you didn't get anything out of it. There are some riders and things you can put on there, but they're really not worth a lot, and they have so many stipulations that it ends up just not being a good idea 9 times out of 10. So that is a true concern. There are, we'll talk about some ways to overcome those objections here a little bit as well, but that's a big concern with traditional long-term care. So the other big one, hybrids. So for those of you who are not familiar with hybrid or asset-based long-term care solutions, they typically are whole life platforms where long-term care is built into it. The ones that we use, and I will show you an illustration here of one. The ones that we use is primarily One America or State Life. You might be familiar with them as State Life. But these kinds of premiums are guaranteed. The nice thing about it is if you don't use the long-term care portion of it, then you have a death benefit. So it's also a legacy play, which is really attractive to a lot of people. Hey, if I don't use this long-term care that I probably need to purchase, then it's a legacy play. My family gets some money. They get some of the money that I put into, and that's really attractive to people. Of course, now that's going to be more expensive, right? There's your, there's one of your cons. That's a more expensive product. Now, but there are different ways to get into that product that are really, really exciting. And we'll talk about that here in a little bit. I kind of went over these already. One of the really neat things, a couple of neat things about One America's product specifically is you can do couples. So it can be a last to die. You can have 2 people on the exact same policy. Very, very attractive for a lot of people. They're utilizing the death benefit funds as money for long-term care. And if both of them go in at the same time, then they can both use the max amount at the same time. So I know that doesn't happen very often, but that's a question that comes up a lot. So they can absolutely do that. So you're utilizing those funds as a couple instead of having to buy 2 different policies. And again, those premiums are guaranteed. That's a big, big thing that people ask about and care about. The other really cool thing that One America does that I'm fairly certain that nobody else has available is they have a lifetime rider. So how One America technically works is you have your whole life policy. Let's say it's $200,000. you essentially have $200,000 of funds to utilize for long-term care for yourself and a spouse, however you set it up. And how that works is, let's say, because you can kind of dial in, that's just like Mutual of Omaha, how much you want to benefit, what your benefit wants to be a month, because they know that when we put my parents in the nursing home that we probably end up in, it was X amount of dollars. We want to make sure that it at least pays that. And you dial that in, let's say it lasts 2 years before it exhausts that 200,000. One America has a rider called a COB, or a continuation of benefits, where it refills that pool of money and you get to do it all over again. Now, it's not a death benefit, so that portion of the policy is cheaper than the initial portion was, because you're not buying a death benefit, which of course obviously makes it more cost effective. And you can make that rider for 2, 4, 6 years, or even a lifetime. So if you have clients who have a family history of especially Alzheimer's, that's the big one, where people have had family members who have been in nursing homes for 5+ years. We know the average is creeping up over 3. It used to be right at 3, and it's well over that now, because people are living longer, and so if the average is around 3, but for those people it's 5, 6 plus, or unknown. Some people have been there for a long time. How do we make sure that we don't run out of funds? I can't find a policy that'll go as long as grandma was in the nursing home. One America can do that for them. Obviously, that's going to be the most expensive way to purchase coverage, but they know everything else in their life is protected. All their other assets are protected. They won't have to sell. The big thing around here is the family farm. That's a huge one. You don't want to have to dip into that or sell it to fund long-term care. Again, that's one we hear about quite a bit. I kind of went over some of these already. Get ahead of myself. I will point out here on this one, you can pay it multiple ways. There's many different ways to pay a single premium, multi-pay, 10 pay, all sorts of ways to pay this. So here's a little idea of how asset care works. Again, we've already kind of talked about that. But so I'll take this moment to talk about one of the neatest parts about asset care. So you have these multiple options you can pay, right? How many times have you sat down with a client, if you've done any long-term care, how many times have you sat down with a client and you've shown them that illustration that you got, and their eyes just, oh my goodness, that's way more than I thought it was going to be, and they check out. You can tell your whole conversation you're having with them, they are not interested. This is always why you want to have a couple other options available, maybe some lower premium ones, but I'm sure you've all been there where these clients have checked out and you're here trying to salvage this meeting with them, and there's no way they're paying this. One of the cool things about asset care is you can use qualified money to pay for long-term care using One America. And it's really, really neat. I'll show you an illustration here in a little bit. Essentially how it works is, again, how many people do you run into when you're out talking to clients that can afford $300, $400 a month into their budget to pay for long-term care? Some certainly can. People buy them all the time. How many people do you run into that have diligently saved their entire life? They have a decent size 401k. They have all this qualified money, and they're primarily going to probably turn that into an income stream, right? Which is fantastic. But what if you take a little bit out of that? You section maybe $150,000 out of that qualified fund, their 401k, and they use it to solve their long-term care problem. One America will do that. You can take money from your 401k, put it into a long-term care product, and now you have your long-term care and potentially a legacy play as well. Because if you don't end up using it, then it pays as benefit to your beneficiaries. So it's really a win-win. It's a fantastic way to solve that need, especially for clients who, I can't spend $300 a month because I've done the math and we're going to use this money for income. But then you have the conversation about, well, what if we use a portion of this money, just a little bit of it, to solve the long-term care need? If you don't usually have a legacy play, people respond to that. It has been a fantastic story and a fantastic product for us here at PIPAC the last couple of years, as we've kind of leaned into that and had tell that story and use that as a solution. People have really responded well to it. I should say, I thought I had a slide on this. When we go back to the emotional portion of long-term care, how it's important, um, why you want to make sure you're making that connection. One thing that we've really found um, a lot of success in is having that financial conversation with your clients. So I would say, and I'm sure most of you would agree, when clients come to you and are talking about long-term care, they usually come to you and say, okay, we put my mom in a home and it's $8,000 a month, it's $9,000 a month. So we need a solution for $9,000 a month. And that makes sense. We used to just take that and say, yep, all right, here you go. Here's a $9,000 policy, which might be way out of your budget, but that's what you need, right? So you need to purchase that. The truth of it is, if you spend some time going over their funds and talking with them about their specific situation, not only will you cover other opportunities for sales. I think long-term care is one of the best lead-in products that there is out there right now, because everybody has questions about it, and you can use it to discover whether they have lazy money that you can turn into annuity sale. Maybe they need something for final expense. Maybe they need something for income for annuities or more life insurance. Who knows? You'll uncover that by having the financial conversation about long-term care with your clients. So essentially what you're doing is you're saying, for easy math, you need $10,000. That's what your mom's spending. So you want to cover that. How much do you make a month? So again, just for easy math, let's say they bring in $10,000. You say, okay, if one of you were to go in the nursing home, how much money would the other spouse need to live month to month? And they say, oh, $5,000 would be plenty for them to live if there was just one of us. You say, okay, well, you have $5,000 that can then be used for your long-term care coverage. You freed that up by one of you being, unfortunately in a home. So really, they only need a $5,000 long-term care policy, which of course is much more affordable. It's going to fit into their budget. You're going to close more long-term care sales with that approach. So make a point to really dive into their specific situation instead of just kind of hearing their need and directly solving for that $10,000 long-term care need that they've brought up to you. That has helped close more sales than I can count, having that
Justin,
conversation. Oh, yep. Sorry.
sorry, we did have a
You can interrupt
question
me
that
anytime.
popped up.
Sorry. I just ramble.
This one I thought would be best to answer right when you're talking about this. So, are the qualified funds that you said moving out of that 401k, are those taxed when you move those into that long-term care policy?
Yes. And I should have mentioned that I'll bring that up when I bring up the illustration, but yes, to go over it, essentially how it works, it's really neat. It creates a 10-pay annuity in the background. You never see it. The clients get their policy. They just see this whole life policy that they have. But what's happening is every year that annuity that's in the background is going to make a payment towards the policy. Again, clients don't have to do anything. That's happening automatically. Then they'll have to pay taxes on that money that came out and made that one payment. So it spreads that burden over 10 years as opposed to one big uh, chunk that you got to pay right away. And the nice thing about it is, if you unfortunately were to pass in the first 10 years, you're actually going to end up with a better policy, because all that money is still there, right? It hasn't been used, it's not gone. And I can show you that real quick in the illustration when we get there. But yeah, that's a really great question. And it's one of the neatest parts about the policy is you're also lessening the tax burden too. So you're solving potentially for a need or a question that the clients have there too. A lot of them uh, will ask that question unless maybe they have, or we're going to pay so much, and when we turn this into an income stream, well, you can lower that and solve for that as well. So yeah, that's a fantastic question. I'll show you that here in a minute when we get to that slide.
Thank you.
So overcoming some of these common objections, I'm sure you've all heard it. Everybody, well, I want to buy it, but it's too expensive. And really, that's an easy one because compared to the cost that you're going to face when you end up in a nursing home, likely again 70% plus, that number keeps going up as doctors learn how to keep us alive longer and keep us healthier longer. That number is going to keep going up. And so, people today, it's going to be more than 70% of you that are going to end up in there. So how do you solve for that if you're not going to do it? There's a guy that I've worked with in the past, and he created a little form that he carries around. And essentially, if they say, thank you for your time, but no thanks, we're not interested, he'll say, hey, no problem. If you like, I'm going to leave this form here with you. And it's just a list, and it shows this is the order I would like to liquidate my assets in to pay for long-term care for my children. When they need to make that decision, I've now given you this information, savings, house, farm, whatever. And it helps with that emotional realization, that connection to the fact that this is real and I need to make a plan for it. I'll never need it. We already touched on here as well. 70% of people are probably going to need it. It's almost certain. Don't want to lose control of my money. That's actually a more common one now, especially as the market's doing so well. We've seen a little bit of a slowdown in the using qualified money to pay for long-term care, especially for the people who are in 55, 60, who are really just trying to reposition some of their funds to limit their exposure. So they're not, hey, this chunk of funds is not in the market anymore. It's protected and it's doing something for me as I plan for my future. With the market doing so well and people making money hand over fist, we are seeing a little bit more of a hesitation towards that and more gravitation towards the traditional long-term care. But really, as we already talked about when I answered the qualified money question, then what happens with the taxes there, it's just repositioning those assets. And in a lot of situations, it's a smart thing to do because you're taking that money, you're taking that away from exposure. The risk is gone. And now not only is it protected, it's solving some of your future problems. So that's an easy one too if they're bringing that up. And if they really do want to keep that money in there, then of course you have the traditional long-term care, or with the hybrids, you can of course pay those just like any other policy, month to month, annually, whatever you want to do. So again, as we kind of put this all together, and you're having these conversations, making sure that we're understanding the cost of care, that you're discussing that burden that can happen if you don't have anything. Introduce those products, have a understanding of how they work, present the hybrid solutions because the vast majority of clients are going to have never heard of those. And there's a lot of them out there. Lincoln has one, Nationwide has a great one, Securian has a good one. They all work a little different than One America's, but it's the same idea, same approach, good products. Show them how asset care can solve multiple problems that they might be having. So many solutions there with one product. Illustrate those, have a couple options, and that's what we always do. We always make sure when we're talking with the agents that, hey, here's what they asked for. Here's a lower one. Here's a higher one, just in case they say, oh, that was far more affordable than I thought it would be. You don't have to stop everything and make a phone call or have another meeting for saying, no, you don't want to do that. Long-term care, more than any other product that we sell, by far, you rarely get the first illustration exactly right, exactly what they're after. So having a couple extra of those is always helpful. And, make sure that they're understanding, how this is funded, how it's working. So when you're closing that and you're hitting that emotional, spot for them, that they're really understanding that. So I know, most of the time when I'm presenting to PIPAC agents, I know them all very well. I've been here for 11 years, and I know what they're involved in, what they sell, their neighborhood, their community. And so for you all, I would say, even though a lot of us haven't met, some of us have, a lot of us have not, I feel really, really comfortable saying that if you spend the time to learn about long-term care, you can almost without question be the go-to person in your community for long-term care. And that goes a long way. I made the Medicare comment earlier. It's the same thing. My dad's a perfect example of this. My dad's a brilliant guy, but when it came time for him to, start to look into what policies he was going to purchase, and then for my mom and all that kind of stuff, they get mailer after mailer after mailer and commercial after commercial and email and all this stuff, and they're bombarded from all these places and what's true and what isn't, and how does this work? And am I making the right choice? I think long-term care is exactly the same from that perspective. Like they hear all this stuff, they know what's out there, they've had a friend experience it or a loved one experience it. What's true? How does it work? I heard it's expensive. How can I make sure I'm buying the right thing? How can I become educated? If you take time to do that, become that educator, become that go-to person, you'll rake in referrals like crazy because everybody's going to want to come to the person who will take the time to understand them, understand their situation, and make sure they're getting the right policy for them. So that's a huge thing. Make sure you really dive into that. And again, um, with a little bit of work, you can easily be the go-to long-term care person, and it will open up so many other things in the life and annuity world for you. Um, so I kind of went over all these in one big thing, but really making sure they understand what they're buying is massive. That will go a long, long way. I'm going to bring up some PDFs here. Thought I had this all closed, but so we're going to go over these just real quick. This is the One America illustration. When I first started doing One America illustrations, they worked on this little program that you had to install on your computer. And if those of you remember, like Windows 98, MS-DOS, and all that stuff, that's what it looked like. And it would spit out like a 2-page report. And now it's 17 pages. But really, to me, there's only 3 pages that matter. Because we get the most response out of the qualified purchase, and we get a lot of questions about that, that's the one that I went with. So if you're looking here, that's what we're doing. We're putting in $150,000. Their algorithm kicks it to a 149.9, but we're putting in $150,000 of qualified funds. That gives you a $37,500 premium bonus. So what you're doing is you're putting in $187,500 into this product. And you can see right down here, to answer the question from earlier, this is 10 annual distributions of $18,750. So there's your tax responsibility there every year. So you can kind of plan ahead for that. This is the main page, the one that I spend the most amount of time on when I'm talking to a client about One America. It kind of puts everything in one little spot. You can see what we put in. You can see the face amount that we ended up with, $221,000. That's what this purchased. And the total amount of benefits that we use with the continuation of benefits is 660, a little shy of 665,000. So how does that work? Right here, you can see that this purchased $9,232 of benefit. So each client, these are 60-year-old male and female, each client can use a little over $9,000 a month for long-term care coverage. If they both went in, you can see it would be almost 18.5. So they can both use it if they need to. That will pull from this pool of money right here. If they use it, it'll last them 2 years of using that maximum benefit. 2 years, that'll be gone. What we've done here is we've put on a 4-year continuation of benefit rider. That's where we're coming up with this extra funds here. So now you have a total of 6 years. So we're, again, using the lower end of average between the two of them. So if one's in there for 4, they have 2 more, 3 and 3, whatever the combination is. If one person uses all 6, then you have a different problem. But of course, we're just planning using the data that we have at hand, right? None of us really, really know. If you bought the lifetime, of course, this right here would say lifetime, and that would lower your money, your 150,000 you're putting there is going to buy you less. This is going to go down, and this is going to go down. But you also have more time. You're never going to run out of it, which means a lot to a lot of people. I didn't really talk about inflation. You can put inflation on both of these products. I tend not to because it's the most expensive part of a long-term care policy. The only time you would really want to, especially with mutual Omahas, is if you need that partnership qualification. I can show you that when we look at that illustration here. in a moment. So to kind of show you, to go back to the question about the funds and how they're taxing that, this will kind of show you what's happening. And you can see we're lower in that total death benefit every year. It's making a payment until we get down to the illustrated one of 221,005. So again, if they were to pass earlier, they're going to have a much higher benefit, but the amount of money that's in there is going to instantly then be taxed. Now, of course, they both have to pass because it is a second to die. So that would be unlikely in this particular illustration, but it's still good to know because the clients will probably ask you that question. And again, these are very high level overviews of these products, but they're also kind of that simple. They're not as complicated as a lot of people think that they are. So then we'll go over to mutual Omahas. We're doing the same thing, illustrating a couple, keeping in mind that with Mutual Omaha and pretty much every other carrier, these are going to be two separate policies. It looks like they are one, but it's actually two. They're each going to have their own policy number. They're each going to have their own premium payments. But they do get a little bit of a benefit for not only applying together, but also purchasing together. And we'll see that on the next page here in a second. Same kind of idea. We're trying to do as close to apples as we can here. So what we've done is we've done a $9,000 benefit, just like we had over at One America. And we're doing it for 3 years. So on both of them. That gets them a pool of 324,000. That's the pool that they will pull from. Now, of course, that is not a death benefit. That's just their pool of money. We're back to that use it or lose it discussion that we had at the beginning of the presentation. So that is exactly right. Whatever they don't use would go away. You see here, I've lowered these. This saves them some money. And with long-term care presentations, I've found in my experience that it's better to start with the lower end one so you're not sliding that illustration across the table and just losing them right away. I've seen it happen too many times. And so now you kind of start with more of a stripped down one. Here's just some of the basic things that we talked about. You talked about how you needed $9,000 a month. You know, I probably have one pocketed for $5,000 after you have that exploratory discussion about what kind of funds they can use that come in every month to pay for long-term care. But we'll start with this. And since it does pay for assisted living and home health care, we've lowered that to 50%. So we're at $4,500 a month from this policy that can be used for assisted living and home health care. And of course, if you do that, it just comes out of this $324,000 pool. So really, you could do home health care the entire time and use this entire policy limit. Again, that stay at home mindset, stay at home longer. To that point, people don't use this a lot, but this cash benefit, 25% of whatever the home health care is, which in this case would be $1,100. You can use that money for whatever you want. As far as Mutual Omaha cares, you can take it out and go to the casino and put it all on red. It doesn't matter. What most people do, though, is they use it to change things in the home so they can stay home longer. Maybe they buy a lift chair, or they use it to help fund a wheelchair ramp, or do some changes in the bathroom for the shower to make it more accessible. That's something that you actually could do. Same exact thing. It just comes out of this policy pool, and you can take that $1,100 out every month if you'd like, and do whatever you want with it. So that's another benefit of a Mutual Omaha. And there's the partnership qualification that I was talking about. The partnership qualification is a big deal for some people. Some people come looking for that specifically. And what that does is, the reason it says no is because I don't have inflation on there. You need to have inflation on there to make it partnership qualified. What the partnership qualification does is it takes this policy limit, and you can use that as an exemption for Medicaid. So if you're going to do a spend down, you now can shelter 324,000 of your assets because you have a partnership qualified policy. Essentially, the state is saying, if you go out and buy something to protect yourself instead of relying on us to pay for it, we'll give you a break. So you can do that with Mutual Omaha. You just have to have the inflation on there, which of course does really bring up the price of the product. So we'll go to the premiums. You can see they're getting a little bit of a savings here because not only are they both insured, they're both insured. Sometimes they'll say both applying. If you know one's not going to get it, apply for both of them because you'll get a savings on it. Just by being married, they'll get I believe, a 5% savings. So that's always good to put in the application. You can see here $317. So, of course, long-term care is the only time that the females are more expensive than the males. A lot of agents ask that question because they're so used to seeing female rates being lower than male rates. Not so much in long-term care because, of course, women tend to live longer and they're the ones that tend to end up in the nursing home. So the likelihood that they're going to have to pay this out is higher. So the premiums on the females are more expensive, significantly so, as you can see. So combining those together, they're at $317, and bearing in mind that is likely, of course, to change, not right away. It usually takes 5+ years or so, if not even longer. And maybe it only happens to them once or twice. But it is something for them to be aware of. They do need to know that because it changes what they're buying. I like to put this piece in every illustration that we do for Mutual Omaha. For some crazy reason, it's not included. It is something we have to add. But this break-even analysis is really, really neat. And it helps with that emotional connection, that understanding the likelihood of using it, how powerful actually buying insurance is, even though maybe they see $300 a month and they're like, "Ooh, $300 a month," but really $150 a person is not that bad at all. You put it into perspective, and then you show them the break-even analysis, which of course cannot take into account any potential premium increases, but it will use what you have on here, and that's as good as we can possibly know for sure. And I always like to look at 80 because it's a nice number, not too young, not too old here. And you'll say, let's say you have this policy, 60-year-old clients for 20 years. You're 80, you go into the nursing home, you've paid $300 and some for 20 years, maybe that went up. How many days do you need to be in the nursing home before you're making money off of Mutual Omaha? All the money you've invested in Mutual Omaha in this policy has come back. It's paid out in benefits. How long before you're making money off the company? 98 days. We're just under 100 days. That's a really powerful piece, and it resonates with people because they really understand the power of the insurance that they're purchasing and what they actually bought and how it helps them out. You're just there for 100 days, and the average is over 3 years, and the rest of it's all on Mutual Omaha because you bought this now. That really lands a lot of people. Again, because it's two people, they're going to do it again and show you the page on the other spouse. That's how they set those up. But that's Mutual Omaha one. By and large, that's all I have for you. I wanted to leave a little bit of time here at the end for questions if you had any. I know tend to get a lot for long-term care. If you don't have any, that's okay. But wanted to leave at least 15 minutes here at the end for any questions that you had about long-term care.
Yeah, thank you, Justin. Wow, that was a lot of great information. I learned so much about, the new types of hybrid policies that are out there. And I think that last exhibit that you showed us, where it showed how many days they have to be confined in order to start making money, that I think that would resonate with a lot of people because
Yep.
we always get the feedback that, well, what if I never need to use it? Or, why am I just paying in if I'm not gonna, get a true benefit out of it? So I think that really helps underscore the importance and the value that you're getting out of those policies.
Yeah, for a 70% chance you're going to end up in there, that risk is worth the reward there for 98 days.
I did also really like to hear about that asset protection. So as people are, if you did want to pay for that inflation adjustment, if you will, that you can get that value of that policy excluded from your assets when you're looking at, the buy down piece as you're
Yeah.
going into care.
Yep. A lot of people, that's what they're after, especially the farmers. Big part that they're after.
Yeah. We did just get a question. Does Mutual of Omaha offer single pay or 10 pay?
They don't, which is kind of frustrating.
Can you explain
So
a little bit about what that is?
yeah, so with most of the hybrid products, because it's on a whole life chassis, which we're used to seeing as single premium, 10 pay. So you pay it in 10 years and then it's all paid up. 20 pay, with whole life, you'll see pay to 65. So they pay daily 65 and then it's off the books. So that's why you can do that with most of the hybrids because they're on whole life or IUL chassis. So that's easy to do. That's easy to solve for. Mutual Omaha can't do that because I suspect some carriers did that. Uh, and there's no way for them to know what their exposure is, right? So let's say they let you pay yours off, and then all of a sudden long-term care triples in price, and they're going to let you in for what you bought 10 years ago. That's how they go out of business. So I suspect that's one of the big reasons why they don't do that.
Great question. Anybody else have more questions for Justin? I think it's a lot for us to take in and consider. We're getting
Yeah.
a lot of thank yous in the chat. So really great information, Justin and PIPAC. We appreciate you being a sponsor of NABIP and to all our sponsors on the call. We couldn't do what we do without you. We appreciate your help as we advocate for Iowans and this complex health insurance market and really all the insurances that we deal with. So. Thank you again, everyone, for joining today. Just keep in mind, we do have another virtual session on Thursday, May 7th, so just in a couple days.